Central banks didn't evolve naturally. They were designed by the people who needed them most. And what they needed was a system where money could be created, distributed, and recalled at will. Not by governments, not by markets, by a very small group that understood one truth above all others. Control the currency and you control the collapse. Every empire that tried to break free from this pattern ended the same way. Monetary sovereignty stripped away, debt spirals locked in, and a final stage where the illusion of independence becomes impossible to maintain. We're watching it happen again, right now, and the script hasn't changed in 300 years. This isn't about conspiracy, it's about incentive structure. Central banks exist because governments cannot be trusted to manage their own money supply. That's the stated reason. But the actual function is far more elegant. Central banks create the conditions where collapse becomes manageable. Not preventable, manageable. They don't stop the cycle, they control its speed. And every time a nation enters the late stages of monetary dependency, the central bank becomes the only institution with leverage. Not because it's powerful, because everyone else is already drowning. Rome had no Federal Reserve, but it had the exact same problem. By the 3rd century, emperors were debasing currency at rates that would make modern central bankers blush. The silver content of the denarius dropped from 90% to 5% in under 70 years. Why? Because Rome couldn't tax enough to pay its legions, maintain its borders, or service its grain subsidies. So it printed, it debased, it created money out of thin air. And for a while that worked. Soldiers got paid, bread stayed cheap, the illusion held until it didn't. By the time Diocletian tried to stabilize the currency in 301 AD, the entire monetary system had collapsed into barter in the outer provinces. The empire didn't fall because of barbarians. It fell because no one trusted the money anymore. And once that trust broke, the empire fractured into pieces that could sustain local economies. The center couldn't hold because the currency couldn't function. Spain learned the same lesson 200 years later, when silver from the New World began flooding into Seville in the 1500s. The Spanish crown thought it had solved the resource problem forever. Unlimited money, unlimited power. Except inflation doesn't care about the source. It only cares about supply. Within 50 years, Spanish silver had destroyed Spanish purchasing power. Prices rose 1600%. The crown debased its own coinage to try to keep pace. And by 1627, Spain declared bankruptcy for the 4th time in 70 years. It didn't matter how much gold and silver they hauled out of the Americas. The monetary system was broken, and the people running it had no mechanism to stop the spiral. They just kept issuing more debt, more currency, more promises they couldn't keep, until the empire stopped being an empire and became a protectorate of French bankers. Britain did it slower and smarter. The Bank of England was founded in 1694 for one explicit purpose: to finance a war the government couldn't afford. In exchange for a loan of £1.2 million, a private corporation received the right to issue currency backed by government debt. That model became the template. The central bank doesn't serve the government. It finances the government. And in doing so, it becomes the only entity the government cannot afford to lose. By the time Britain reached imperial overstretch in the early 20th century, the entire system was running on debt issued by the Bank of England and purchased by London financiers. When World War I broke out, Britain couldn't pay for it with taxes, so it borrowed. When the war ended, it couldn't repay those debts, so it inflated. By 1931, Britain abandoned the gold standard because maintaining the value of the pound would have required austerity so severe it would have triggered revolution. The empire chose inflation, and within 20 years, the empire was gone. Not conquered, dissolved, because the currency could no longer hold the system together. This brings us to the pattern itself, and it runs in 6 stages, every single time. Stage 1. A nation borrows to finance something it believes will generate future returns. War, infrastructure, expansion. The borrowing seems rational because the gains seem larger than the cost. The currency remains stable. Inflation stays low. Trust remains high. No one worries because the debt is still small relative to the economy. This is where most empires live for decades, sometimes centuries. But the mechanism is already in place. Once borrowing becomes normal, it becomes necessary. Stage 2. The returns don't materialize as expected. The war costs more than projected. The infrastructure doesn't generate enough growth. The expansion hits resistance, but the spending continues. Because stopping would mean admitting failure. So the nation borrows more, not to invest, to service the previous debt. This is the pivot point. Debt stops being a tool and becomes a structure. The central bank expands its balance sheet. Interest rates stay suppressed to keep the system liquid. And the economy begins to require constant monetary intervention just to avoid contraction. The population doesn't notice yet. Growth continues. Employment holds. But the foundation is shifting from productivity to credit. Stage 3. Inflation becomes persistent, not hyperinflation, just enough to erode savings faster than wages rise. The central bank faces an impossible choice. Raise rates and collapse the debt structure, or hold rates low and let inflation accelerate. It always chooses inflation, because the alternative is immediate systemic failure. So the currency loses value. Slowly at first, then faster. The population begins to feel it. Housing costs rise, food costs rise, energy costs rise, but wages don't keep pace. The central bank insists this is temporary, transitory, a supply shock, anything but the truth. Which is that the debt load has become so large that the only way to service it is to devalue the obligations. And that means devaluing the currency itself. Stage 4. Trust begins to fracture, not all at once, but in pieces. Foreign creditors demand higher yields. Domestic savers move into hard assets. The wealthy begin moving capital offshore. The central bank responds by increasing intervention. More liquidity, more bond purchases, more emergency lending facilities. It calls this stabilization, but it's the opposite. Every intervention increases dependency. And every increase in dependency makes the next crisis worse. This is where the illusion of control becomes obvious. The central bank cannot fix the debt problem. It can only delay the reckoning. And every delay makes the final collapse more violent. Stage 5. The currency loses its external credibility. Trade partners stop accepting it at face value. Foreign reserves shift toward harder currencies or commodities. The nation's ability to import declines, not because of sanctions, because no one wants to hold the currency long enough to complete a transaction. The central bank can still print, but printing doesn't create value. It only redistributes it. And at this stage, there's nothing left to redistribute except the remaining trust. The domestic population feels this as a collapse in living standards. Imports become unaffordable, savings evaporate, pensions lose value, and the government has no solution except more of the same. More borrowing, more printing, more promises. Stage 6. The system resets. Not by choice, by force. Either the currency collapses into hyperinflation and gets replaced, or the nation defaults on its obligations and restructures under external oversight, or the political system fractures and the central authority dissolves entirely. History shows all three outcomes, and history shows they all come from the same place. A central bank that prioritized short-term stability over long-term sustainability. A government that chose debt over reform. And a population that believed the currency would always hold value because it always had before. We are deep into stage 4, and the signals are everywhere. The Federal Reserve's balance sheet exploded from 900 billion in 2008 to 9 trillion by 2022. It has never returned to normal, because there is no normal to return to. The debt structure cannot survive without constant intervention. US national debt now exceeds $34 trillion. Debt service costs are approaching $1 trillion per year. That's more than the defense budget, more than Medicare, and it's accelerating. The Fed cannot raise rates high enough to control inflation without triggering a debt crisis, and it cannot lower rates without reigniting inflation. So it oscillates and calls it policy. The European Central Bank is in the same trap. Negative interest rates for nearly a decade. Bond purchases that turned the ECB into the largest holder of European sovereign debt, and an inflation crisis it cannot contain without collapsing the peripheral economies. The Bank of Japan has been trapped in stage 4 for 30 years. Its balance sheet is now larger than Japan's entire GDP. It owns more than half of all Japanese government bonds. And it still cannot generate sustainable growth, because growth doesn't come from central banks. It comes from productivity. And productivity has been sacrificed to keep the debt structure intact. China thought it could avoid this. It built the largest infrastructure program in human history, financed entirely by debt. And for 20 years, it worked. Growth stayed high. Employment stayed strong. The currency stayed stable, but the debt kept growing. And now China's local government debt exceeds $9 trillion. Its property sector is collapsing. And its central bank is trapped between reflation and default. The pattern doesn't care about ideology. It doesn't care about economic models. It only cares about math. And the math always wins. This is why central banks exist. Not to prevent collapse, to manage it. They are the release valve on a system that generates more debt than it can service. And when the pressure builds too high, they open the valve. They print, they lend, they intervene, and for a while, the system stabilizes. But every intervention makes the system more fragile. Every stabilization increases the dependency. And eventually, the central bank becomes the system. Not a part of it, the whole thing. And when that happens, collapse is no longer a risk. It's a timeline. The people running these institutions are not stupid. They know the math, they know the history, they know the stages. But they also know that stopping the cycle would trigger the collapse immediately. So they keep going, not because they believe it will work, because stopping guarantees failure. And continuing offers the possibility of Yanshu, one more quarter, one more year, one more election cycle. This is not incompetence. This is the rational behavior of actors trapped inside a structure they cannot escape. And that structure was designed 300 years ago by people who understood exactly what they were building. A system where monetary sovereignty becomes impossible, where governments become dependent on debt, and where central banks become the only institution with the power to decide when the collapse accelerates. The final stage is always the fastest, not because the collapse happens suddenly, because the denial breaks suddenly, and once it breaks, the realization spreads faster than the institutions can respond. Spain collapsed over decades, but the final breakdown took less than 5 years. Britain declined over 50 years, but the loss of reserve currency status happened in 1 generation. The Soviet Union looked stable until 1989, and then it was gone in 2 years. The pattern doesn't announce itself, it just completes. We are watching central banks lose control in real time, not dramatically, incrementally. Every policy failure, every inflation spike they can't contain, every emergency measure that becomes permanent. These are not signs of temporary difficulty. They are markers on a map that has been drawn before. And everyone who studies the history knows where this map ends. The central banks know, the governments know, and increasingly the population knows. The only question left is how much time remains before stage 5 becomes undeniable, before foreign creditors begin to price in currency risk, before capital flight becomes structural, before the illusion of stability collapses into the reality of managed decline. This is not a prediction, this is a pattern, and the pattern has never been broken, not once, not by any empire, not by any system, because the incentives don't allow it. Breaking the pattern requires accepting short-term pain that no democracy will vote for and no autocracy will risk. So the cycle continues, and the central banks continue managing it until they can't. And when they can't, the system resets and a new cycle begins with new currency, new institutions, and the same underlying pattern. Because the pattern isn't about money, it's about power. And power always protects itself the same way. By controlling the one thing everyone needs and making sure no one else can create it. If this helped you see where we are in the cycle, subscribe. Because in the next video, we break down what always happens next.